Hey everyone, it's Mike Bonn, and today we're going to go over how to fund a flip and BRRRR. Today is all about the proper two-step funding for a BRRRR. We're kind of taking this from the lender's perspective. Why is there two loans? You have the buy and you have the refinance. We're going to go over not only why, the cost, and then also, the benefit of setting this up correctly so you can take out as little money as possible. We hear a lot of the gurus out there saying, like do a cash out refinance. We say never, if you ever can, do a cash out refinance. Do the rate and term, and we're going to go over that here in just a second. So as always, we have different series we're doing. The first series of every month is all about funding BRRRRs, funding flips. We're also going to go over funding VRBOs. So some of the basics, like I said, I've been in finance over 30 years, been in the investment world 20 plus years. So if you haven't seen one of these videos, there's a lot of great information out there from how to get your credit score up. If you don't have experience, all of those kind of things, you could go out and check it out. It's on YouTube, hardmoneymike.com. If you can, please subscribe, like all those other things. It helps us get the message out to more people. And that's our goal. Our goal is to help people get into investing, and then also get to the point where they're free and three. That's what we call it, is getting to the point where you can actually have the income from investing, either from flips, VRBOs, BRRRRs, in 3 years, take you and give you the life that you want. It might be just quitting your job. It may be just working less. You still probably have to do some things, but we've taken people from little to nothing, literally, to being free in 3 years, being they could do whatever they want when they want, all based around real estate investing. And that's what we're focused on. We're focused on the real estate investing. Our goal is to make you successful. If we can make you successful, it's a win for our communities because you're fixing up properties, making properties better, creating rentals, vacation rentals. And it also creates income from you, and it keeps us, going in business. What we do which is on the lending side. Once again, we're looking at this from the lending side. Even today, we're going to go over BRRRR, but we're just going to go over the B, the buy, and the R, the refinance. The two loans that go with it. Why do you need two loans compared to one? You always hear out there it's like, okay, it's a lot more costly because you have to do two loans. So you're really adding one loan to the equation. We want to go through that because you have to know exactly what it's going to cost. And is it worth it to do a BRRRR and pay for two loans? So we want you to understand it up front. And a lot of gurus out there talk about cash out refinancing on the R. And we just want to go through from a lender's perspective why we say cash out is something you try to avoid at all costs and go with a rate and term. So being from the lender side and seeing people come to us and say, hey, I want to refinance, get my money out, we're going to show you the easier path, the cleaner path to get there. So number one, why are there two loans in BRRRR? And today we're talking about BRRRR. We know there's other ways to buy rental properties. You could buy retail, you could do home hacking, all that stuff. This is all about BRRRR. So in the BRRRR, there's two loans always involved. So we have to start with the basics. So what are the two loans out there? There's a purchase loan. That's where you purchase the property. And then there's a refinance loan. So once you own it, you can refinance it into a different kind of loan for cash out, rate and term, whatever it is. So number one, why there's two loans is on the purchase side, traditional lenders, your banks, your mortgage companies and everything, if you go through them for a loan, they're going to require that you put more money into the deal. Typically on a rental property, 20%. And the whole idea of BRRRR is to get in with as little as you possibly can. So by guidelines, by what they have to do, if they do a purchase, they have to go by the lower of what you purchase it for or appraised value. So if you're buying something under market and it's move-in ready, but it appraises for more, they still have to use purchase price. So that is why you have to purchase, and we'll go through it with the kind of loan you have to go through. But once you own it, even if you own it a day, 2 days, a week, once you become owner of that property, the lending rules change. So now you could go get a conventional conforming traditional loan and use appraised value. So you could use the value of the market compared to what you bought it for. The other reason there's typically two loans in BRRRR is we deal a lot in value add properties, properties that need a lot of work. So with those projects needing a lot of work, that means we're going to need to put money in. Traditional lenders are not going to lend you that money to fix them up. So two loans. We have the purchase, and that's typically purchase it and get it fixed up. And then we have the refinance, which allows you now to use the actual value. And that is where you get into little to no money in. So first loan, acquire. You have a couple different options when you're looking at the purchase side, the acquiring side of the property. You could use a bridge loan, hard money loan, which typically, and it depends on who you use, can fund up to 100% of your costs. So that means your purchase price, your rehab, even sometimes your carrying costs and stuff like. It depends on how you buy the property, but hard money bridge loans are typically what you use in BRRRR because they can finance more of the project. If you go to use a first loan or a purchase loan and you go to a traditional bank or lender, they're going to be at that 70 to 80% of the purchase and rehab, depending on where your credit and everything is. So if you're looking at BRRRR properly and you're trying to get this into this with little to no money, you want your purchase money loan to be maximized out. So it will cover less money out of your pocket compared to a traditional lender. And we'll show you why briefly in this. We could go through in a couple other videos of why that's important when you go to the refinance. So once again, we said, there's a purchase and we just did the purchase, but then there's a refinance. And the refinance is where you refinance it into a long-term 30-year low interest rate loan. This is what you're going to carry it with. And as we say, is if you're looking for BRRRR and the true no money down, you're going to have to go by what we call the 75% rule. And that is, if you're buying a property and your all-in cost, your purchase, your rehab, your carry, whatever, is 75% of the after repair value or less. So for instance, if you have a property that's going to be worth $200,000 and you could keep all those costs, purchase, rehab, everything else, below 75% of the $200,000 or $150,000, in essence, you could do BRRRR with zero into the project. So we call it the 75% rule. When you're looking at a project, can you be in all in for 75% of the market value, the ARV, including all your costs? So this is the refinance. You purchased it. Now you get to go refinance it depending on your amount of money into the project, how good a deal you got. This is where you could be in for little to no money. So the second loan typically comes from a bank, a traditional lender, a conventional, DSCR loans, whatever it is. This is where you're going to get into the long-term, the cheaper money, and use that equity you just created. So you might have bought it for, just like I said, 150 and rehabbed it all for that number. Now you need to refinance it. Typically in rental loans for conventional, traditional, they limit you to the 75%. That's why we go with the 75% rule. There are other options out there that'll go a little bit higher. The rates just are higher. The one thing we say when we set this up, and we set this up correctly, is that we would love you to get pre-approved for your second loan, your long-term loan, before you start buying, because that lets you know exactly what you're going to get, what kind of loan you qualify for, expectations for loan to value and everything. So if you know that going in, you know the kind of properties you need to look for to hit your goals. So the second loan, once again, we had a purchase loan, and then we had a refinance loan. Purchase loan is because you need to wrap more of the fees in there and then more of the costs in there. The second loan is to refinance, and we're going to show you the correct way to refinance that coming up. So we have this little guide. We could send it out to you, but step one is the purchase. That's where you buy, you fix it up, and you maybe get it rented. Step two, and this is the two-step in the loan, is to capture and use that equity that you've built, you've created by buying something that needs value add, putting the work into it, bringing it up to market. Now you get to refinance it, long-term loan, because you own it, and you get to use the appraised value. So The key is you get to use the appraised value because you already own it. Compared to purchase price, they must have 2 loans in there. So quick and dirty, you hear about it, or we've heard it, we've seen it. It's like, hey, well, you're doing 2 loans, it's going to cost you a lot of money. So typically what we look at, and we tell people to put this in when you're, looking at a BRRRR kind of transaction. You want to know all your costs, because your loan costs, you're going to add 1 more loan to this compared to a retail deal. Because in a retail deal, you will buy it with a loan typically, and you won't have to do the refinance. So there's 1 extra loan. But we look at both loans. So both loans are probably going to add between 3 and 5% in fees to the deal. So for instance, when we talk about that $150,000 all-in transaction, let's just say we could add another $4,500 to $7,500 in fees, appraisals, underwriting to that. And we want to count that in the cost of doing this transaction. No different than rehab costs, insurance costs, all that stuff. We're going to put those in those numbers to make sure it's a good deal up front. And then depending on how long it takes you to fix it up, you're going to have 2 to 6 months of higher than average interest because you're using a bridge loan. Hopefully, it also means you were able to get a renter in there faster, get it fixed up faster. And typically what you're going to find, and we go through this in other videos, is when you're using a hard money or bridge loan, you're able to close quick so that seller gave you a discount. And all of these things add up to where it makes sense to do, but all your costs of your loans should be just like your rehab, and it should be in your numbers, and it should not be on top in a surprise to you. So, but we always look at it as like this: when you're evaluating a BRRRR kind of property, is the cost of 2 loans, that extra 1 loan, worth you adding, instant cash flow and net worth into your life? Because that's what you're doing. You're creating cash flow and net worth in a perfect world out of nothing, but using other people's money. So is adding 50 to a couple $100,000 in net worth and a few $100 a month in cash flow worth it as you keep building and building, and maybe someday you do it with cash? Other people always love to use other people's money. So we always look at this from a lender's perspective, and like, how can we maximize out these transactions and these loans? But you also have to take into account that there is that extra loan, and you had to have to add those costs to your budget, just like you do rehab. So next, I wanted to go through, the buzzword out there, cash out. You hear it on the podcast and stuff. Do the refinance, get your cash out. And here's where we kind of split from them and how we set things up, because we're looking at never, if possible, doing a refinance that's a cash out. So let's start with the basics. There are 2 kinds of loans out there when you're refinancing. One's a cash out loan and one's a rate and term loan. And they're handled completely different in underwriting, when banks and everyone are looking at them, what they'll give you, what they'll do, and even the costs associated with them. So cash out refinance. So when we're looking at a cash out refinance, that means you are getting more cash out when you refinance, when you take out a new loan, than what is owed on the property. A lot of people get a little confused here. They're like, hey, but I bought it for something and I took a loan out, and then the rest of the money I just put into the property. I mean, I paid contractors and stuff. So I'm not really getting cash out. I'm just getting my money back. It doesn't matter. I see that perspective. But lenders, they look at that, any money that comes out of the property that is not to pay off the current lien is called a cash out. So if you've paid those people out of pocket and you're looking to get that money reimbursed, cash out will help you do that, but maybe it was just set up wrong in the first place and we should have looked at a rate and term. So cash out loans, the negatives here for us, there's a longer holding period as far as conventional conforming and some of the traditional loans, because they do require at least 6 months of holding it, which means you're going to be paying higher interest rate on those bridge loans during that time before you could use appraised value. Typically, there's less funds available because they give you a lower loan to value on a cash out refinance than they do on a rate and term. And there's typically higher costs between 1/8 to 1/4 in points and some higher fees that go along with it. It just limits you on your cash flow going forward because you're going to pay higher costs, and the amount of funds you can get back out, and how long you have to keep that hard money loan. So our approach and how we set it up on the purchase side is we make sure all those fees, costs, and everything are included in that first loan, the purchase, the rehab, and everything else. So when they go to refinance, as soon as they're done, maybe they're done in 6 to 8 weeks, they could refinance quickly into a long-term loan without waiting, because the conventional traditional loans, Fannie and Freddie, do not have a holding period requirement. Like I said before, you could buy it February 1st and you could be refinancing it February 15th and use an appraised value. There are some lenders, some banks and everything who say that that's not how they do business, and that's true. That's not how they do business. But probably 70-75% of the lenders out there don't do what they call overlays on Fannie and Freddie, and they do allow you to use appraised value as soon as you own it for the refinance. Once again, a rate and term over a cash out, you're going to get more funds. 5 to 10% more funds available means you have higher loan to values on your loan. So if you're looking to max out your leverage, rate and term will allow you that. And they just have better rates, better fees. It's just better to do this if you're looking at doing BRRRR with little to no money out of your pocket. This is the way to go. And it's all set up by that loan number one, which means at purchase, you're using a loan that covers not only your purchase, your rehab, and some of the other costs associated with that. So when you set it up, you have to make sure you work with a lender that'll set it up correctly. So as I went through in this episode, like there's 2 letters in BRRRR that comes up with 2 loans, the buy and the refinance. And why do we need those? Because we have to own it to use appraised value. So we have to purchase it. We probably have to do some rehab. And then once we own it, we can refinance it and use that captured equity on the new loan, so we don't have to take money out of our pocket. And then the cost, we said that there's, somewhere between a 3 and 5% cost for those 2 loans, which means, there's somewhere between a, 2.5 and 3.5% extra cost because of the one other loan. And then we also went over why not do a cash out, do a rate and term. So it also just goes back to BRRRRs. We look at it as most of the clients in a BRRRR are looking to put as little to no money in, and that all comes back to setting up your loans correctly. If you have a deal, if you want to talk to us, if you want us to look at a deal, you could call us or you could email us. If you're still in that, gathering information, trying to think of some stuff, go out to our YouTube channel. We have a lot of great content out there. If you can subscribe, like some of the stuff, all that, anything you could do, anything we could do to help, reach out to us with those kind of questions. Next up, we're going to go through the 2-step BRRRR funding. So we're going to go through real numbers. Like what's the real numbers when we look at a retail buy compared to a BRRRR? What's the real numbers, cash out versus rate and term? We're going to go through just doing these 75% rules just so you can see it in real numbers, and then how we do bridge loans compared to some of the other lenders where we try to max out the initial purchase loans so you have less money into it. So join us next week, and as always, happy investing.